Here we are, cost, volume, profit analysis, part 1. Get excited. So given different levels of business activity, cost behavior allows us to evaluate what can happen in the future. So if we, for example, were in a global pandemic and we thought that manufacturing was going to slow down, what costs are we still going to incur despite very low production levels? And more importantly, this CVP analysis allows us to determine necessary sales levels to reach desired profits. In fact, it's going to give us a lot more even than that. We're going to look at many different scenarios together. So for most costs, we will assume within the relevant range that as volume increases of production and sales, that the sales revenue and unit variable costs stay the same, as well as the total fixed cost. They don't change within the relevant range. The selling price is the same for every unit, the variable cost is constant per unit, and the fixed costs are constant in total. We also assume that all costs can be broken down into variable or fixed, right? So even if it's a mixed cost, we can break it out and separate it. So let's look at our traditional absorption costing income statement, the one required by GAAP, the one required by the Internal Revenue Service. We know that as sales minus cost of goods sold equals gross profit minus selling and administrative expenses equals net income. Well, if you will, humor me for a moment. Let's break out cost of goods sold and selling and administrative expenses into variable and fixed, because we assume that even if it's mixed, I can split it up. So that would be sales, right? And when I split out my cost of goods sold, that would be sales minus variable cost of goods sold minus fixed cost of goods sold equals gross profit. Now I want to split out my selling and administrative expenses into variable and fixed. So then I'm going to subtract out my variable selling and administrative and my fixed selling and administrative and get net income. This net income should equal the net income of the first statement we did. And all I did was break out cost of goods sold and selling and administrative expenses into two flavors. Now I want to do the shell game. I want to move some of them around. So I want to take my sales, and my variable cost of goods sold is going to stay where it was. But now I'm going to move my variable selling and administrative up. Okay? So I have sales minus variable cost of goods sold minus variable selling and administrative expenses. This gives me contribution margin. Then I want to subtract out my fixed cost of goods sold, then my fixed selling and administrative, and get net income. Notice it's just a matter of formatting. I moved two numbers into two different places. These two net incomes should still be the same. So let's further condense this a little and say that my sales minus all variable costs, and my all variable costs are my variable cost of goods sold and my variable selling and administrative, give us contribution margin. And let's combine fixed cost of goods sold and fixed selling and administrative into one and just call it fixed cost, and this will give us net income. So notice that from going from the traditional income statement to the CVP income statement or contribution margin formatted income statement or variable costing income statement, all of those apply, all we did was mix up, move around some of the components of the income statement. And so in the end, as long as my sales equal my production, all these four net incomes should all equal. So sales minus cost of goods sold equals gross profit minus selling and administrative expenses equals net income. That's traditional. And then after we go through a few reiterations, we can pop out on the other end sales minus variable cost equals contribution margin minus fixed cost equals net income. And it's a matter of just changing the position of some of the pieces and parts of our income statement. When I have this contribution margin formatted income statement, it is very useful and I can use it to make lots of decisions. So this is the chapter of 1,000 formulas. Never doubt it. But let's consider this example first. Let's assume that in your spare time you make funnel cakes. And everybody loves your funnel cakes. They cost you $3 to make, and your neighbors, who love it when you're making them, are willing to pay you $5 for every funnel cake. So the state fair is coming to town, and you think it would be a great idea to sell funnel cakes there. So you go to the fair management and you say, "Hey, can I sell funnel cakes here?" And they say, "Sure. You can sell funnel cakes here at the state fair, but you're going to have to pay a $100 registration fee to do so." So how many cakes do you have to sell at the state fair to break even? So for us, break even means that you have no profit and no loss. Think about this for a moment. So I'm hoping that you said 50 funnel cakes. If each cake costs you $3 to make, and you can sell them for $5 each, well then you have $2 for every funnel cake that you sell going towards profit after you cover your costs. And in this case, our costs are the $100 registration fee. So if you sell a funnel cake, you've got $2 to go to cover your costs, the $100 registration fee. How many cakes do you have to sell to break even, have no profit and no loss? Well, it's 50 cakes. So did you need a formula to solve for that? Many of us don't, because the question was intuitive, but never doubt in this chapter of 1,000 formulas that there is a formula to solve for this. This is the chapter of 1,000 formulas, so let's start off with 4 basic formulas. The first 2 that we're going to look at regard contribution margin. So contribution margin per unit is selling price per unit minus variable cost per unit. What does it tell us? Well, it tells us how many dollars are left over after I cover my cost to start covering my fixed cost. Once I cover all my fixed costs, which remember are constant in total, then every dollar of contribution margin after break even goes directly towards profit. So in our funnel cake example, we had selling price of $5, variable cost of $3 per unit, so our contribution margin was $2 per unit. Another important thing we need to know is the contribution margin ratio. For us, this is selling price per unit minus variable cost per unit, which we know is contribution margin per unit. We take the contribution margin per unit and divide by selling price per unit. And what does this tell us? Well, this tells us the percentage of each sales dollar that we take in that can be used to cover fixed costs. And then once all the fixed costs are covered, the percentage of each sales dollar going forward, in essence after break even, goes directly to the bottom line or to profit. So when we look at our funnel cake example, the contribution margin per unit was $2. Selling price was $5. This gives us a contribution margin ratio of 40%. So 40% of every sales dollar we take in goes to cover fixed costs, and once the fixed cost is covered, then 40% of every sales dollar we take in goes straight to the bottom line. So let's talk about 2 huge formulas that we're going to use a lot of, and that's break even. We spoke about that earlier. Break even is when I have no profit and loss, and we could solve for break even in units. How many units do I have to sell to have no profit or no loss? Or we could solve it for dollars. How many dollars do I have to sell so that I have no profit and no loss? So break even in units. Formula is, let's take our fixed costs and divide by contribution margin per unit. And this will tell us, of course, how many units I have to sell to have no profit and no loss. So in the funnel cake example, that would have been 50 cakes. Break even in dollars is that we're going to take fixed costs and divide by the contribution margin ratio. Or an even quicker and dirtier way is if I have break even in units, I can multiply it by selling price. So what does it tell us? How many dollars I need to sell to have no profit and no loss. So in the funnel cake example, if we had taken the fixed cost of $100, right, the registration for the state fair, and divided it by our 40% contribution margin, and be careful, in decimal terms, this is 0.4, we would have gotten $250. Or I could have just taken the number of units, like break even in units, which we decided was 50 units, and multiplied by the selling price per unit. If you remember, we sell these for $5 a piece, and we would have also gotten $250. So let's recap. We've got contribution margin per unit, which is selling price per unit minus variable cost per unit. We have contribution margin ratio, which is contribution margin per unit divided by selling price per unit. We have break even in units, which is fixed cost divided by contribution margin per unit. And break even in dollars, which is fixed cost divided by my contribution margin ratio, or the break even in units, if I know it, times the selling price per unit. And let's add an example. In our example, selling price of our product is $40 per unit, variable cost is $22 per unit, and fixed costs are $540,000. So if I wanted to calculate contribution per unit, I would take the selling price of $40 per unit, subtract out variable cost per unit of $22, and get $18 per unit. If I wanted to solve for contribution margin ratio, I would take the contribution margin per unit of $18, divide by selling price per unit of $40, and come up with 45%. If I wanted to solve for break even, I would take the fixed cost of $540,000, divide by the contribution margin of $18 per unit, and come up with 30,000 units. And if I wanted to know break even in dollars, I could take the fixed cost of $540,000 and divide by my contribution margin ratio of 45%, which in decimal terms is represented by 0.45, and come up with $1.2 million. Or the quick and dirty, if I already know break even in units, which I do, 30,000, multiply that by the selling price of $40 per unit, I would have also come up with $1.2 million. So let's recap. We've got our product that we sell for $40 a unit that has a variable cost of $22 per unit, fixed cost $540,000. We've calculated contribution margin per unit, $18, contribution margin ratio to be 45%, break even to be 30,000 units in units, break even in dollars to be $1.2 million. And let's go ahead and proof this. All right, so contribution margin per unit, selling price of $40 minus our $22 variable cost per unit equals $18 per unit. So let's go ahead. That matches up with what we had calculated earlier. Let's calculate break even using our formula. Let's prove it. I know that total contribution margin, according to our calculations, we were going to need 30,000 units to break even. And I want to multiply that by my $18 contribution margin per unit. This gives us $540,000. I know that total contribution margin minus fixed cost, which is given as $540,000, gives us net income of $0. And that is what break even is, right? Where net income equals 0. Let's do the same for break even in dollars. So here we go. Contribution margin. According to our calculation, our break even in dollars is 1.2 million. So I want to take that, total sales, right, and multiply that by the 45% contribution margin ratio, because we're saying that the contribution margin ratio of 45% is that 45% of every sales dollar equals the dollars allowed to cover fixed costs, which when we multiply out is 540,000. Our fixed costs, of course, are 540,000, and this gives us net income of 0. So we have indeed and can indeed proof break even. and we've done so. So let's recap. Okay. We've calculated contribution margin per unit for this example. We've calculated break-even in units, and we've proofed that when we sell 30,000 units, our profit is zero. That is the definition of break-even. We also said at one point that once we passed break-even, right, and covered all of our fixed costs, the contribution margin would directly go to the bottom line for every unit that we sold past break-even. So we're saying the break-even is 30,000 units. What happens if I sell one unit more than break-even? So if break-even is 30,000 units, that would be 30,001 units. Let's calculate net income now. So contribution margin. If I sell 30,001 units, with each unit contributing $18 to cover my fixed cost and then go towards profit, my total contribution margin would be $540,018. Now remember, fixed costs are constant in total. So even though I'm going to sell one more unit, it's not going to change my fixed costs. Fixed costs are constant in total. So my fixed cost would be $540,000, and this would leave us net income of $18. So remember, once we get past break even, my net income should equal the number of units I've sold past break even times the contribution margin per unit. So taking it another step further, what if instead of 30,000 or 30,001 units, what if we sell 31,000 units? What would our profit be? Well, if we know that break-even is 30,000 units, and now I'm selling 31,000 units, that's 1,000 units past break-even. So I would take the 1,000 units, multiply by $18 contribution margin, and I would expect my net income or profit to be $18,000. So what if instead we sell 25,000 units? What would our profit be? Well, break-even is 30,000 units. Anything above 30,000 units is profit. Anything below 30,000 units is loss. So in this case, we're selling 5,000 units less than break-even. So we are going to suffer a loss, and the loss is going to be the 5,000 units times the $18 contribution margin, or a $90,000 loss. So let's use some of these thoughts to make some decisions. Ellis Company sells one product. Their selling price is $10 a unit, variable cost $8 a unit, fixed cost $6,000, and their current level of sales 15,000 units. So they place a suggestion box in the cafeteria, and 4 suggestions are submitted to the box to hopefully increase profit. And the first one says, well, you should increase advertising by $5,000 and your sales will increase to 18,000 units. The second suggestion says, increase the quality of your raw materials. People have complained for years that this is a crappy product. So make it a better product. You increase it from, plastic to metal maybe. Don't make it so flimsy. And this will increase your raw material cost or variable cost from $8 to $8.25 a unit. Customers would be willing to pay $10.15 for this new and improved product. And your sales will increase to 17,000 units. Third suggestion is, okay, don't change the product. We got a crappy product. Just reduce the selling price so that it's more in line with people's expectations. Reduce the selling price from $10 to $9.50 and increase advertising by $3,000 to tell people you have reduced the price, and sales should increase to 18,000 units. And then the fourth suggestion is don't change the product, but increase the selling price to $11 a unit. Increase advertising by $5,000, saying that, this product is high quality product and you deserve the best. And if you increase your advertising by $5,000 with this message, then you can sell your product for $11. However, your sales will decrease by 10%. So which one of these is the better suggestion? Well, let's see. Before we consider any of those suggestions, however, we need to calculate what our net income currently is. There is always the possibility that all of those suggestions are poor, right? That they will give us less net income than we already have. So let's check and see what our net income is currently. So I'm going to do the quick and dirty. I know that my total contribution margin is the contribution margin per unit, which is selling price per unit minus variable cost per unit, or $2 a unit, times my current level of sales of 15,000 units. So I have a total contribution margin of $30,000, and when I subtract out the current level of fixed costs, which are $6,000, this leaves me with net income of $24,000. So if any of the four suggestions don't give us a net income of $24,000, well then I'm not interested. So let's look at suggestion number 1. Increase advertising by $5,000 and sales will increase to 18,000 units. So looking at our current information before we make any changes, selling price of course is $10 a unit, variable cost $8, fixed cost $6,000 in total, current level of sales 15,000 units. So I need to know, first of all, does contribution margin per unit change? And contribution margin per unit is selling price minus variable cost. There's no mention in this suggestion of changing the selling price or the variable cost. So my contribution margin per unit doesn't change. So let's look at what we currently have is net income after we look at our suggestion here. So the quick and dirty, again, I know that my total contribution margin is going to be my contribution margin per unit, which didn't change, right? So $2 a unit times the number of units that we'll sell. And under this suggestion, it is said that we will sell 18,000 units. So when I take the $2 contribution margin per unit, multiply it by the 18,000 units, this will give me $36,000. Fixed costs were originally $6,000, but they're telling us that we need to increase our advertising by $5,000. This is a fixed cost because it's given to us in total. So now my fixed cost will now be $11,000, the $6,000 plus the $5,000. And when I subtract that away from the $36,000, I would project net income to be $25,000. Well, currently our net income is $24,000, and I like to make more net income. So suggestion 1 is, $1,000 higher, and this makes me happy. I'm all about suggestion 1. So let's look at suggestion 2. It says increase the quality of the raw materials. So this will take our variable cost from $8 to $8.25. However, people are not willing to pay the whole quarter for this increase in quality. They're only willing to pay $10.15 for it when normally they had been paying $10 before. But if we increase the quality of our product, then we could sell 17,000 units. So at this point, my contribution margin does change. So I need to calculate a new contribution margin per unit. It would be selling price of $10.15 minus the variable cost of $8.25. So when I do that math, I get a $1.90 contribution margin. So let's calculate suggestion 2's total contribution margin. It is going to be $1.90 per unit times 17,000 units they think we can sell, or 32,300. Fixed costs, there's no mention of any change in fixed costs, so we will assume that it is still $6,000 because in the relevant range, a fixed cost is constant in total and doesn't change. This would give us net income projected to be $26,300. So let's look at suggestion 1. That was $25,000 of projected net income versus what I currently make, $24,000. And at this point, again, I'm always in it for the money. I'm all about suggestion 2. Suddenly, suggestion 2 is definitely my winner. So suggestion 3 says, well, don't change the product, just change the price. Drop your selling price to $9.50 and then increase your advertising to tell everybody about your new lower price. And people will flock to your product and they will, sales will increase from 15,000 to 18,000 units. So I look and I notice that my contribution margin per unit has changed because my selling price has changed. So let's calculate the new contribution margin per unit. I take selling price of $9.50. I subtract out $8, and this gives me $1.50 per unit. When I go to calculate my quick and dirty net income for suggestion 3, I want to take the 18,000 units times the new contribution margin of $1.50, and this will give me contribution margin of $27,000. Now, fixed costs were $6,000, but they want us to increase the advertising of $3,000. So that's going to bring our fixed cost to $9,000. When I subtract this out, this will give us a net income of $18,000. I currently make $24,000. I'd be a fool to pick up suggestion 3. Suggestion 3 is a dud and we should ignore it. So let's look at suggestion 4. This suggestion says don't change anything about the product, just jack up the price to $11. There are some people that just assume that if it sells for a higher price, it's better. It must be better. We see this in some industries with wine per se. All right, people just assume a $40 bottle of wine is better than the $8 bottle, and that's not always the case. But this suggestion says increase the selling price, increase advertising to tell people how fabulous their taste is in buying this product. And sales will, of course, decrease some, but it's really a good idea. So let's see if it is. Notice that selling price is changing. Therefore, I have a change in my contribution margin per unit. So if I take the $11 new selling price and it doesn't change the product any, so the variable cost still stays at $8, we have a contribution margin of $3 a unit. So let's look at what's going to happen to net income. I need to calculate my decrease in sales first. So notice that currently I'm selling 15,000 units. If my sales are going to fall by 10%, then I'm actually going to keep 90% of my sales. And therefore, my sales after this change will be 13,500 units. Calculating my net income for this suggestion, we take total contribution margin to be the 13,500 units times the $3 contribution margin per unit and get $40,500 total contribution margin. The fixed cost will go up by the amount of advertising, and now my fixed cost will be $11,000, giving us a projected net income of $29,500. And when I compare this to suggestion 2 and suggestion 1 and my current income, well, suggestion 4 by far is the winner. Right? So we are here to provide information to management to help them make good decisions. We in accounting are going to push suggestion 4, but we're not the only ones at the table suggesting things to management. So in addition to accounting sitting at the table saying, project 4, we like, suggestion 4, it makes the most net income because we're all about the dollars. There's people like marketing that are saying, oh, heck no. We've worked too hard to get our share of the market, our market share, and you want to voluntarily turn away customers? And then there's HR. They're sitting at the table and they're saying, well, if you're going to reduce production by 10%, you're probably going to lay off 10% of your people. We don't want to lay off our employees. This will give us a black eye in the community. It's going to cost us money. It's going to make us look bad, and so on and so forth. There'll be a lot of people at the table that don't like suggestion 4. And there is a good chance suggestion 4 won't win. But for accounting purposes and for this class purposes, I like suggestion 4 because it gives us the most net income. So look at this question and calculate an answer for me and meet me at the next slide. I know that total revenue is $500,000. My total variable costs are $330,000, and my total revenue is $500,000. And if I do this math, I'm going to come up with 34%. So if you will, calculate break even here for me, and I will meet you at the next slide. So we're looking for break even in dollars. Let's do it the quick and dirty way real first before we look at the formula way. I know that selling price is $20 a unit, variable cost per unit is $16, so contribution margin per unit would be $4. And I know that break even in units is to take the fixed cost of $240,000 and then divide by my contribution margin per unit of $4. This would be 60,000 units. And if I take 60,000 units and multiply by $20 a unit, this will give me $1.2 million. So if I ever know an answer in units and I want to find it in dollars, I can multiply the units answer times selling price. But let's do it the formula way. Okay. So contribution margin per unit is $4, right? Selling price minus variable cost, $4. Contribution margin ratio is the contribution margin per unit, right? $4. Selling price per unit minus variable cost per unit, $4, divided by selling price per unit of $20, this will be 20%. And then break even in dollars is my fixed cost of $240,000 divided by the contribution margin ratio of 20%, and this would give us $1.2 million. Try this one on your own. Meet me at the next slide. So let's remember our formula. We know that sales minus variable cost equals contribution margin. Contribution margin minus fixed cost equals net income. And for us, we know that break even is when net income equals 0. So the only way that net income can equal 0 in this formula is if contribution margin equals total fixed cost. So remember that after break even, contribution margin per unit goes straight to the bottom line. So we've got Abby here. She sells a product that she sells for $100 per unit, and variable costs are 25% of sales. So 25% of $100 is $25. So when we calculate contribution margin per unit, we take the selling price of $100, subtract out variable cost of $25. This gives us a contribution margin of $75 per unit. And after break even, right, every product we sell past break even, net income equals the number of units past break even times the contribution margin. So if Abby sells one more unit past break even, her net income should be $75. You've got this. So we've looked at some of the basics of cost volume profit analysis. We've looked at contribution margin, we've looked at break even, and we've seen how useful this knowledge can be in making some business decisions. But it is the chapter of 1,000 formulas. So never doubt in our next slideshow, we're going to have some more formulas. Get ready and get excited.